You're live. Hello, everyone. Hello. The comment section, the chat area is already active. Hey, Roderick and John and Ann. Give it just a couple minutes. Danny, Cheryl, Dorothy. We're supposed to have like 500 people who RSVP'd to this thing. So let everyone kind of troubleshoot. We are going to record it. I have no idea how long I'm going to go. I haven't gone through the presentation and timed myself. But we will be recording it and distributing it. So if you get pulled in another direction, just know that we'll be sending you a copy of it. I think if you're in the webinar room, you get the copy instantaneously. But if you're not here, I guess you wouldn't know if you're not here. We put the thing on YouTube and then we send it. But that usually takes 2-3 days to get through compliance and everything. Hello, everyone. Virginia. I like that when people put their where they're writing in from. Let's see who wins the prize for the farthest away. We got anyone in Europe? I know for certain we got several people in Europe right now. All right. Hey, Bill. Virginia. All right. All right. Well, I want to be respectful to everyone's time, especially being as though that we're recording this thing. Let's just get this show on the road. Hopefully we don't break down like Verizon wireless coverage yesterday. I don't know if anyone else was impacted by that, but having 4 kids 8 and under and not being able to call your wife to talk through the logistics of the day is not a good setup. You realize how vulnerable you are. All right, we do this every year at the beginning of the year. Matter of fact, one of the things I'm going to shine a light on later on is we're going to do more and more of these. I think the people have spoken. They enjoy kind of some economic commentary, and they want to know if we're making any adjustments within our models and their portfolios on account of that economic commentary. So we're going to do more and more of these, but this is our the one that we do at the beginning of each and every year. Just giving you a 2025 year in review and a 2026 market forecast and outlook. And then the very last slide is just some updates that are going on around here at the firm. Drink in this. This is our compliance slide that we're required by law to show you. By the way, the chat section, Brittany's in here. Her camera's not on. She was having a little technical difficulties with the camera. So I think she'll be actively communicating with you. If something comes up, she'll be able to chime in. Oh, I need to shut the chat section. Otherwise, I'm going to be distracted. Okay. All right. Compliance is done. Look at this chart. So this is the stock market in 2025. Hard to believe we were down 20% in April. I mean, people are fickle. I'm fickle. I'm like, man, what a great year in the market. The market was down 20% in April. We had the longest government shutdown in the history of the government being open. All in a year's work, but the S&P 500 closed up nearly 18%. The NASDAQ outpaced once again, up about 20%. We use ticker BND to summarize like the overall bond aggregate. This is the best bond outcome I've seen in the last 5 years. And even prior to that, I think we had one reading of like 8, and then it was, much lower for many years there before too. So finally, people who are buying bonds are being rewarded a little bit. And then finally, dividend stocks, which we use ticker VTV to represent dividend stocks or value stocks, lagged the S&P 500 once again, but strong 15.2% rate of return. One asset class that was down last year was Bitcoin, down 6.3%, but that's rebounded pretty well here to start off the new year. We were at 100 yesterday per 100,000 per Bitcoin yesterday. I should have shined a light on gold, but gold would have broken the whole chart. Gold was up about 65% last year as people fled to the metals, not only when the market crashed, also when the government shut down. The flight to safety trade was on. So unique year in the market, but a good year in hindsight. 20% drop, longest government shutdown, all kinds of AI news, Trump tweeting away, and the market eked out a really strong year. So one of the great things about being independent. One, I think I'm unemployable, so there would be no other way I can work anywhere else. But we don't have to beat to the sound of our firm's economist or a firm in Lower Manhattan telling us what to sell, what to hawk, what to tell clients. It's wonderful to be so independent. But I'm not so naive as to think all of these large firms have nothing to offer us as investors and offer me as someone who manages money for a living. The great thing about being independent is we can literally listen to everyone but follow no one. We were able to look at all of these big asset managers, and the list that you see compiled on this screen are literally some of the most respected, notorious names on the street. These people manage billions and billions, probably trillions of dollars, and each and every year they'll release their 2026 market outlook. And I am happy to share any single one of these PDF documents. They're typically about 15 pages long. This is how I spent my Christmas vacation, reading all these market outlooks. And what we're going to do today is just regurgitate what they said, dilute them down to kind of the key themes, and then give you, hey, after reading all of this, how we see our clientele, this is what we think you all should do with your money. Okay. So, like I said, if you want to read these, we are happy to send you a link with all of them or one of them, whatever you want to do. Or if you just want the Cliff Notes version, I did all the reading so you can kind of see what each one of these things said here in a hot second. All right. So first on the list is Goldman Sachs. So their 2026 market outlook, they expect equities to keep rising. They're bullish, but at a slower pace than what they saw in 2025. They see a recession-driven bear market is unlikely. They see global equities delivering 15% total returns. Now, let me clue you in on something Goldman Sachs did last year, though. I like Goldman Sachs. Very well respected. Really hard to get a job there. They're poaching the best and the brightest out of college and paying them well. In 2024, so this very same report for 2025, they said the S&P 500 was going to go up 3%. And then midway through the year, they revised it to 10%. Right after the market crashed and it started ripping back up, they go, no, now it's going to go up 10%. So that must be nice. You can kind of just change your call midway through the year. But that's what they did, and rightfully so. The market turned around and wound up going up 18%. So that 3% market forecast didn't look all that good. And to be fair, no one has a crystal ball. This is a pretty hard business to be in. But they see equities growing 15% this year. Now, this is a synonymous thought that a lot of these asset managers have. They see Europe, they see Asia, the emerging markets taking on a bigger role. Value and non-tech sectors are back in the game. Now, what's that? That's big, boring companies that crank out profits, aren't innovating, separate you from your money, dividend stocks that are viewed as cheap through a valuation perspective. So they're high on dividend stocks, high on non-sector, tech sector stocks, and high on international stocks. Here's Goldman's take. Here's Apollo. Apollo is a big player in the private equity space. I saw a stat the other day that high revenue generating firms, these are firms with over $100 million of top line revenue. 87% of them are private, meaning they don't trade publicly on an exchange with a ticker. So this is the line of work these guys are in. They're a private equity manager mainly. They see some headwinds. Once again, they say the U.S. economy is going to be resilient. Looks a little stagflationary. Inflation is going to be stuck at that 3% number. And the headwinds that they see is student loan payments were restarted. You had to start repaying your student loan payments last year. And for many people, that's a big anchor on their monthly budget. You're going to see more and more delinquencies. We've already started to see some more delinquencies with credit cards and mortgages and such. And because of the added stress of paying for student loans, you're seeing more and more people save less. And there's a theme throughout each and every one of these white papers. They talk about a K-shaped consumer economy. So if you look at the letter K, you'll see there's kind of a tail upwards and a tail downwards. And what this simply means is the rich are going to prosper and thrive and do better and better. The asset holders will do better, whereas the people who don't own assets, and not necessarily the poor even, these could just be young people who don't own their home yet, trying to buy that starter home, people wrestling with student loan debt repayment. So there's going to be a continued disparity between the haves and the have-nots. This was a theme that I saw in every single white paper we read. Concentration risk. I like this. So we've talked about on previous webinars that 30% of the S&P 500 is now encompassed by what's called the Magnificent Seven. And it's interesting to think back at 2025, 45% of the stocks that encompass the S&P 500, the S&P 500 is actually 510 stocks for some reason. No one references it, but a little weird factoid. So 45% of the S&P 500 in 2025 was down in value. Yet the Magnificent Seven drove a lot of the performance. Like 75% of the performance of the S&P 500 is driven by the Magnificent Seven, which are exclusively technology names. And these are technology names on the cutting edge, what are called hyperscalers for AI, both innovation and investment and application. So concentration risk is something that one of the other asset managers shines a light on, which I'll cover in just a second. 30% chance of recession. That's almost like the weatherman saying there's a 20% chance of precipitation. That's kind of called hedging your bets. At least they're financial people. They know how to do that really well. Here's BlackRock, everyone's favorite activist asset manager, it seems. They seem to be walking back some of their takes. The AI build-out will rival or exceed any technological revolution in its speed, scale, and the amount of money spent. Like, we'll look back. Of course, everyone remembers the industrialization of America and all the millionaires and trillionaires or billionaires that were made during that, in today's dollars, of course. The AI CapEx spend, I have a slide on it coming up, is unlike anything we've ever seen throughout the course of human history. The largest companies we have ever seen are spending more money than they've ever spent. Couple those two things, you have to believe that's a net positive for the economy. Money has a way of circulating throughout the economy. So when these people are investing in new data centers and investing in new innovative ways to apply AI, it's going to circulate throughout the economy, and that should be a net positive for the economy. Investors are making big calls, whether they realize it or not. No neutral positioning. This is where I think BlackRock hits the nail right on the head. There's a diversification mirage, okay? So I think a lot of people are under the impression, say if you're in the TSP and you have your money in the C fund, which is the S&P 500 index fund within the TSP. So people go, I have the C fund. I've spread my risk across the entire American economy. I've got the S&P 500. Well, little did you know that the Magnificent Seven encompass 30% of your portfolio. And the Magnificent Seven are all spending money hand over fist on AI. So there's this mirage I think a lot of investors have right now where they go, I'm diversified because I own market-based index funds. And what they may or may not know is most of those index funds are market cap weighted. So the larger companies encompass a larger percentage share of their investment. So whether you know it or not, say you're in the TSP and you have all your money in the C fund, or say you're in a 401k and all your money's in an S&P 500 index fund, 30% of your money is betting on AI right now. So what a lot of these people are telling people to do is like, be conscious of that diversification mirage, because AI, while it's exciting, while there's tons of money going into it, the profits aren't backing up these valuations quite yet. You can't justify the PE ratios and the pricing of some of these stocks because their AI initiatives have not generated $1 in revenue. It's unwarranted. So be careful putting 30% of your money into businesses that are investing incredibly aggressively at pursuits that are not turning any ROI over whatsoever. Now, there are some companies that are investing aggressively that I can see being smart uses of capital, but we'll cover that in the coming slides. Here's JP Morgan. This is something that many of you will see in the next couple months. So there is a stimulus check headed your way, but it's not going to be a Doge dividend, or it's not going to be a tariff dividend. Although Christine here in my office, her son's in the Coast Guard, he got his Warrior dividend. They gave all of the active duty military people a dividend or a stimulus check. It's money well spent as far as I'm concerned. These people aren't breaking the bank. But you're going to get a stimulus check by way of a massive tax refund. Of course, the big beautiful bill passed in 2025. Most people, that's going to have impacts on the 2025 returns and an even bigger impact on 2026 returns. But as it pertains to the 2025 returns, once that bill was passed, most people didn't march into their HR office and say, hey, I'd like to adjust my withholding. Most people didn't make any adjustments to their quarterly estimated payments. Now, if you planned with us, you might have done a little Roth conversion. You might have made a little adjustment within your retirement income plan. But many people did not do a single thing as it pertains to their tax withholding after the big, beautiful bill. And because of that, you're cruising to get a nice refund. Refunds this year, prototypically refunds run around $2,000. Refunds this year are going to be approaching $4,000. So many individuals, the average individual, is going to get an extra $1,000 or $2,000 of tax refund when they file their taxes here in late February, March, and late in April if you're a slacker. AI leaders dominate index returns. I just covered that topic, which is increasing vulnerability. 30% of the S&P 500 is almost a bet on AI when you look at the market caps of these companies. Here's Schwab. Schwab had like a little bit of a negative vibe they're throwing. It said markets in 2026 is in an environment of instability, not just uncertainty. They see that very same K-shaped economy persisting. So, the rich are going to be buying, there's going to be a good market for nice watches and luxury cars and airplanes. And all the while, the first-time home buyer is going to be scratching and clawing to just get in on their first house. Ongoing policy changes, geopolitical risks, economic cross-currents point to higher volatility than in past cycles. I will vouch for that. I try to keep a level head looking at markets every single day. Truth of the matter is, the less I look at markets, the more level my head is. But you can feel it. Like last week, the feeling in the air was prosperity. The market's going to rip this year. AI hyperscalers, all the rage. Nothing has boiled over in Venezuela. Everything's good there. Maybe we're going to get a peace deal between Russia and Ukraine. Fast forward into this week, tensions in Russia and Ukraine couldn't be worse. The market's selling off a tick. I guess we're going to take over Greenland. The magnitude of changes that are happening and the pace at which they're happening will most certainly lend itself to a very, very volatile market. Even last year, I call 20% drop in the market in a calendar year. I call that a volatile year. Now, after that drop, it was kind of up into the right at a 45-degree angle with not a lot of volatility. But a 20% drop is enough to get our phones to ring and get people worrying about their portfolios. So Schwab is seeing another volatile year. Here's Vanguard. Vanguard has been, call it bearish for the last 3 years now. They've been wrong, mind you. Market enthusiasm has likely run ahead of its near-term fundamentals. So that's basically echoing what I just said. They go, hey, this AI stuff is really fun and innovative. It's hard not to play on a large language model like ChatGPT or Grok or Gemini and not walk away going, oh my gosh, this is revolutionary. I mean, just have it like, pull up a recipe for you and it'll just blow your mind. So naturally, people with all the capital that's in the system, they're going to throw money at these things. But at the end of the day, you're buying a business and that business has earnings and that earnings needs to correlate with the price or the valuation of the business. And Vanguard's just stating the obvious here. Like these prices are too high. People are, and I don't think it's as revolutionary as some people might think. So they project U.S. equities only to return 4 to 5% annually over the next decade. That's actually up a tick. I've shined a light on Vanguard's market outlook in previous webinars just like this. They were at like 3 to 4% a year ago. So they're actually becoming more bullish, if you could believe that, at 4 to 5%. Whereas typically, U.S. capital markets are to grow 6, 7, 8, 9%. So literally 50% lower than what prototypical U.S. markets do. They think the stock market's only cruising for 4 to 5% per year. Strongest risk return opportunities favor high quality bonds which have not made any money for like the last 10 years, U.S. value stocks, these are dividend stocks, and non-developed U.S. equities. Okay, here's Vanguard's take. Here's Fidelity. You can tell almost by like the amount of writing on this slide, I was getting a little tired of reading white papers at this point. Like they used to be like 3 lines each where I'd use long words. And this particular slide, I'm like, okay, the economy is expected to expand, recession low risk, recession risk low, high valuations are going to create volatility. Kind of same old. None of them stood out too terribly much. A lot of people are going to be interested in seeing this. This is Idea Farm. I wanted to include a housing market outlook. Now, this isn't regional to South Carolina, which is a white hot market still. But even the realtors here locally will tell you that prices are starting to flatten out a little bit, with exception of that K-shape thing. Right? I live on Daniel Island. They just set the record for the most expensive house ever sold last month. It was $12.5 million. Sold in a day, one day. And people are pricing things at the high end of the market as if everything else in the world is A-okay. We've got flush with cash. Everything's great. But you're seeing on the lower end of the market, that starter home kind of flat. Houses are staying on the market substantially longer than they did before. You used to be able to do an open house and, by the end of the day, your realtor would have 3 offers above listing. Not so much anymore. National home prices are expected to be flat. Once again, a K-shaped housing market. Higher income and luxury buyers remain active, while entry-level buyers face ongoing affordability pressure. Affordability is going to be the word. I wish you could sit there and keep track of how many times you hear the word affordability every time you watch the news. It's going to be affordability. Housing isn't breaking, it's recalibrating, whatever you want to make of that. So I think we've grown accustomed to a white-hot real estate market. And if you're in the business of selling a house right now, you might feel a little defeated that your house doesn't sell in a week. It's not normal for a house to sell in a week. Houses are prototypically, don't quote me on this, but 60 to 120 days would be a prototypical amount of time a house might have to sit on the market before someone falls head over heels for it. We have, grown accustomed to this hyper active buying market in housing, and basically what everyone's saying is that's going to go back to some level of normalcy. So what's consensus? Here's consensus. If you read all those white papers, you'll walk away thinking this. A recession is unlikely. U.S. economy remains pretty darn resilient. Value stocks and international stocks are back in the game. You want to be heavy value stocks and international stocks. AI is not in a bubble yet. Build out CapEx spending will entail trillions, with a T, trillions of upfront investment, much of which coming from abroad. Lots of commitments to build. I think of Taiwanese Semiconductors is going to be building a big factory in Arizona, semiconductor chip manufacturer. I mean, even Boeing just announced they're going to increase their Dreamliner facility by 50%. That's coming domestically. Inflation will be stuck at 3%, causing a K-shaped consumer economy. Now, that's not what the most recent reading said. We're seeing inflation tick below 3%. But I think what Trump's having a difficult time doing is there's certain components of the inflation equation that are easy to impact. Gasoline. That's an easy one, right? You just release more strategic reserves. You drill, baby, drill. You go to Venezuela and you pull their leader out of his bed in the middle of the night. You make a good deal with OPEC. Housing, you can build more houses. But there are certain things that we're having a difficult time getting to the bottom of. But we'll see if that prediction's right. Be careful of diversification mirage. I shined a light on that. Expect higher volatility than in previous cycles. Home prices expected to be flat, but that's a regional thing. But they're expected to be flat. So worth noting that Idea Farm did not see a 2008-esque subprime real estate crash that I think most of the people on this call right now will never forget when their house lost 40% of its value. They do not see something like that coming. Now, this has got to be the most canned ham investment advice. I hope I don't sound like this, although it's tried and true. Every single one of these large financial institutions, here's what they said. They said, stay invested, diversify, look to value in international stocks. Stay invested, stay calm. Why? Because it works. It works. It's not about timing the market. It's time in the market. So I'm a bit of a history buff, and I actually collect old periodicals that talk about the stock market. And here's some Time magazines. These are from like the 40s and the 50s, and it's fun to read them. It's fun to see the cigarette advertisements where like a doctor is advising people to smoke to open up their lungs too. But I wonder what we'll look back 50 years from now and say, what the heck were we into? But it's fun to read these things. And it's also fun to see, like, we now have 2020 vision of what the market would do. It says video device disconnected. I'm wondering if I got kicked off. Hopefully not. It's fun to see what the market did after the quote unquote pros made their call. So this business week in the middle has lived in my desk for the last 15 years. And I'll pull it out periodically anytime I have someone, a little too confident leaning forward telling me that, there's no risk at all whatsoever. So let's look at this thing. This Business Week magazine was printed in December of 2007. So, of course, we all know what happened in 2008. The market dropped 40%. But in December of 2007, if you remember, the whole subprime stuff started to hit the fan around October of 2007. So we already had some negative news hitting the wire. Housing sales started slowing down a little bit. Markets started to sell off a little bit. Here we are in December, and these are what the pros were telling us. What the pros are saying. Most experts we surveyed foresee the market going up a bit, but the climb will be tough. Models are predicting the S&P 500 to go up 3% in the next 12 months. To be fair, that is a muted or more bearish upward outlook, but it's upward nonetheless. And then, of course, Ben Bernanke with his iconic quote saying this subprime thing is not going to be that big of a deal. Don't worry about it. Keep spending money, buy real estate. So the pros, the best asset managers, the best hedge fund managers, mutual fund managers on the street in December of 2007 all thought the market was going to go up. And 2008, the market drops 40%. Point is this. All of those asset managers I shined a light on earlier, the most respected, renowned names on the street, Vanguard, JP Morgan, Fidelity, Goldman Sachs, Apollo, I think I forgot one or two. They were dead wrong last year. They were all wrong. So I guess are we to take their advice hook, line, and sinker going into 2026? I'm not. I think you need to listen to everyone and follow no one. But it's helpful, I think, to relay what they're saying. Of course, their economist department is probably a little bit more robust and their budget's a little bit bigger than mine here at our firm. But all of these firms thought tariffs were going to destroy the economy. That's why the market went down 20%, right? Tariffs are going to curb trade. This is a tax, which it is a tax. And it's going to, Trump, remember back in April, Trump's like threatening, 145% tariffs on Canada. He's fighting with everyone. They all thought tariffs were going to destroy the economy. Tariffs have been wildly successful. And they're generating revenue. $30 billion a month in revenue. And trade hasn't dropped hardly at all. Now, I feel for all my small business owners that are in the import-export business, it's probably taken a couple of years off your life, and you've had to invest a bunch of intellectual capital on negotiating your way around it or front-loading orders and such. But net, tariffs have been successful. Any day now, we should be getting a Supreme Court ruling that I've been, refreshing my news wire every single day. Heck, might happen while we're sitting here. Those tariffs might be deemed unconstitutional by the Supreme Court. If that happens, we might have to turn around and rebate hundreds of billions of dollars to countries that we traded with, which, for the record, would be the stupidest thing I've ever seen a nation do ever. But hopefully that's not the way the ruling goes. But that last I saw, I think if you look at Polymart, which is a prediction market, they're betting that the Supreme Court does rule Trump's tariff initiatives unconstitutional. So odds are they're going to rule it unconstitutional. And the funny thing will be this. The market dropped because people thought tariffs were going to destroy the economy. Tariffs didn't destroy the economy. The market went up. Then the Supreme Court is going to rule the tariffs unconstitutional, so the tariffs will go away, and then the market will drop again probably. Just guessing. So this is the profession I chose. Consensus amongst those asset managers that I shined a light on, they thought U.S. equities were going to grow 3 to 5%. They thought it was going to be kind of a down year for the market overall. And we just saw the market was up, about 18%. So it did better than what they thought. Most all of them, just like this year, were really high on dividend stocks. They all love dividend stocks, myself included, if we're being fair. And dividend stocks, they had a good year. Value stocks had a good year, but they didn't beat the S&P 500. It was growth names again. It was technology names again. Which I'm getting a little tired of saying because it seems like it's been the case for the last 3 years or so. So dividend stocks were the way to go. They actually underperformed, but not by much. And then the other problem you get with these white papers is when you look at who wrote them or you look at the firms who generate them, where their corporate headquarters are, where their market forecasting teams are. It's New York, it's San Francisco, it's Chicago, it's Philadelphia. Really bright blue political epicenters. And whether you despise Trump or you think he is, the second coming, um, you cannot deny the degree of media bias that exists surrounding the man. Tariffs were a success. It's hard to find that anywhere. It's hard to see any large publication who fearmongered about the tariffs walk that back and go, yeah, this is not all that bad. It's a lot of revenue we've generated here. So Scott Bessent, who is Charleston's very own Scott Bessent, the Secretary of Treasury, the highest ranking gay Democrat throughout the history of American politics. He said if Trump cured cancer but it caused dandruff, there would be a dandruff epidemic. This is coming from a Democrat, I guess a reformed Democrat. But he sees it. He goes, hey, we're actually doing some good things here, but it's really hard to get that out to the general public. I mean, even Fox News, even your right-leaning conservative media sources are not sharing the good news. If it bleeds, it leads. I guess that's just the media in general. But it's really hard sometimes to get a proper balanced read on the economy because there's just so many boo birds. There's so many biased reporters out there talking about everything that could go wrong, and very few of them are shining a light on all that's been going right. So, they were all wrong. They were all wrong to different degrees, and it's not like they got it completely wrong. Most of them were positive on the markets, and the markets did in fact go up. But we can't take this advice hook, line, and sinker. So what do we know to be true? I think that's a good place to start. What do we know to be factual? Forget about the forecasting into the future. You start with truth. Your base, your foundation should be, this is what we know. This is factual. And then with that, you can start to make decisions on what you should do with your money. Well, one thing we know to be true is stocks are not cheap. They're not cheap. When you look at forward price to earnings ratios, prototypically, the S&P 500 trades around 17. Right now, we're at 22. One standard deviation would be 20. A standard deviation lower would be 13. So we are above a standard deviation to the average of the market. So that means stocks are expensive. I mean, if you look back at the dot-com bubble, it's interesting to see this kind of chart, this trend. During the dot-com bubble, we had PE ratios at comparable levels to they are today. Now, the novice way to look at that is, they were expensive then, they're expensive now. One thing that's not getting factored into this equation is we didn't print $8 trillion before the dot-com bubble. That kind of manifested based purely on irrational exuberance. Right now, we have AI irrational exuberance coupled with $8 trillion that we printed for COVID relief that's sloshing in the system. So I'm not so naive as to think, okay, well, our PE ratios are 22. They're going to crash now. I'm actually of the thought that baseline PE ratios are going to deviate from that 17 number. PE ratios on average will probably tick up. They might be, more close to 20. And we might look back at where valuations are right now and go, hey, this is actually not that overpriced. But historically, stocks are overpriced right now. You're not getting a deal. You are paying $22 for every $1 that business spits out right now. Okay, so you're paying $22 for a business that generates $1 a year of income. An easy way to look at it. Are you willing to buy a business for $22 if it gives you $1 every year? It's going to take 22 years to get your money back. Now, what are companies doing with the money you're investing in them? Well, they're spending it like hand over fist. So this looks at the hyperscalers. These are the people spending money at the highest clip. Amazon, Google, Microsoft, Facebook, and Oracle, quote unquote hyperscalers. You'll see those names over and over and over again this year. Well, if you look back at the percentage of their cash flow that they spent on what's called CapEx spending, right? So CapEx is investment in the business, right? So typically you can see trends. I mean, it's been an upward trend since 2012. And a lot of that is to do with like these companies became more and more profitable since 2012. You know, Amazon wasn't as dominant as it is today back in 2012, but they're on level footing now. And now they're spending upwards to 60% of their free cash flow on investment, most of which is in AI. If you live in like a monolithic community, think Del Webb, think a Lennar community, your mail and certainly your Amazon packages will be getting delivered by robots, certainly within the next 5 years, probably in the next 3 years. That's what 60% of expenditure on cash flow. Now, how does that impact Amazon? I think Amazon's one of the smart AI plays because they've got a huge human capital cost. For better or for worse, this might not be good for the U.S. economy, but for Amazon stock, they're going to be able to shed a tremendous amount of salary costs, getting rid of people and replacing them with robots. That's why they're spending so much money. Take a look at this. Here are those very same hyperscalers. Amazon leading the charge. $137 billion they're planning on spending in 2026. That's darn near 3 times more than what they spent not but 5 years ago. 3 times more they're spending than they did 5 years ago. Microsoft the same, Google the same, Meta the same, Oracle the same. These people are spending a lot of money to be the first to the party. So more to come on this. We have never seen, these are the biggest companies like NVIDIA, for instance. A lot of this money is getting spent at NVIDIA. That's why NVIDIA is, a $5 trillion market cap, I think. That's why they just set the record for the largest company ever. But these companies are like, we talk about oligarchs from the past. Like these are the largest companies we've ever seen throughout the course of human history, even in an inflation-adjusted basis. Right? Everyone knows John D. Rockefeller was the wealthiest person who ever walked the earth on an inflation-adjusted basis. A lot of arguments could be made about some of the people over in the Middle East and everything, or Putin. But John D. Rockefeller was the wealthiest person on paper. And these companies now would put Standard Oil to shame, right? Massive companies, and they're spending more money than we've ever seen them spend. You don't hear this a lot in the news either. Like, everyone's got their eye focused on like a ICE protest going on in Minneapolis. No one's talking about how Amazon is spending $137 billion, how we've got pledges, I believe $16 trillion of international pledges coming into the United States, again, for CapEx spending. Here's another thing we know to be true. Interest rates have dropped, and they're going to drop more. Here's the Fed dot plot. Of course, this is the Federal Open Market Committee. There's 19 members of the Fed. Everyone knows about Jerome Powell, who I think is getting sued right now or something. I didn't even pay too close attention to that. That just seems like a political play. But of course, his tenure is up in May, so we'll have a new Fed chair. But the Federal Open Market Committee releases their dot plot where all 19 members basically say, hey, here's where I see interest rates at the end of 2025. Here's where I see them at the end of 2026. Here's where I see them at the end of 2027. So they're anticipating interest rates to drop 75 basis points. That's this year. It's a little, it's the outlook at the end of 2025. This chart can look a little misleading because it's like, well, Adam, 2025 is already behind us. So they see at the end, so in essence, you take that the year at the bottom of the chart and you round it up. You roll it up. So they see interest rates dropping about 75 basis points in 2026. And of course, interest rates have already dropped 1% with the last two Fed cuts. 1%, actually a hair less than that. It was only 25 basis points on the last one. But we've seen interest rates already dropping, and they anticipate another 75 basis points this year. They see another 25 basis points in 2027 and another 25 basis points in 2028. And then they kind of see a flattening. I mean, to be honest, like, who can see where interest rates are 4 years down the line? I guess the bond market prices it. And of course, the bond market is pricing what's going on with interest rates right now. Interest rates are going to drop. We're going to see them drop next year. Here's one of the reasons why. Trump and his power of his Truth Social tweets. Here he is calling Jerome Powell Too Late Powell. That was his nickname for him. I don't think that one really stuck. But he said this would be a perfect time for Fed Chairman Jerome Powell to cut interest rates. Cut interest rates, Jerome. Stop playing politics. Trump's under the impression that Jerome Powell is not America First. He's not MAGA. Although I believe he did, in fact, appoint Jerome Powell, which is kind of an interesting dynamic. But Trump doesn't like Powell. He's not making any secrets about it. Powell's term's up in May. And you got to believe, I think Trump's list is down to like 5 candidates. Who do you think Trump's going to pick? He's been trying to get interest rates dropped for a while now. He's going to get the most hawkish, the most aggressive Fed chair who's going to be aligned with his economic initiatives. And his economic initiatives are pretty clear. Drop interest rates and let the economy rip. So I think there's no secret here that interest rates are dropping. And I think that 75 basis points number, personally, if I was like, I would be this weirdo down here who thinks interest rates are going to go below 3. You know, everyone else, and I don't know who this person is, they think they're actually going to rise. I'd be this lunatic way down here. I wouldn't be surprised if interest rates punch the 3% level by the end of next year if Trump gets his guy. Now, his guy needs to be approved by the House and the Senate. That's not someone that he could just anoint. But, you know, he's still got a super majority here, and that vote will happen before the midterms, which, once again, Polymart are expecting to go the way of the Democrats. All right. It wouldn't be a presentation if I didn't shine a light on my beautiful family. So in the middle there, that's Claire's grandmother. She's 102 years young. And then, of course, my 4 kids. And what does comfort food versus hot sauce mean? I forget what the whole analogy was. I'll tell you what it means. Grandma, she can cook it up. Now, she's slowed down a little bit. She's not cooking as much as she did. She lives over at Daniel Point, so they cook for her. She basically lives on a cruise ship, much to my chagrin, because this woman used to make, she could turn anything into a pie. It was like chicken pie and tomato pie. Everything was a pie, and it was delicious. And she knew, you know, the key to my heart and belly was macaroni and cheese. So anytime I visited Grandma, she would make macaroni and cheese, and I was happy. Now, what does hot sauce come into play here? If you know me or have ever eaten with me, much to Claire's chagrin, she'll slave over the stove all day long, execute a recipe with all sorts of exotic flavors, and prototypically, without me even thinking, not because my wife isn't an awesome chef, without me even thinking, she'll make me a plate and I'll just slather it all with hot sauce. I'll cover the whole thing with hot sauce. And she gets so pissed because she's like, Adam, you can't even taste what you're eating. You've covered your entire meal with hot sauce. Funny thing about Grandma's comfort food, it didn't need hot sauce. Not once did I break out the bottle of hot sauce at Grandma's house. And not because I didn't want to insult her, because it didn't even cross my mind. Just last night, we had a rotisserie chicken, broccoli, potatoes, delicious, nutritious meal. What did I do? Cover it in hot sauce. So my take here is there are comfort food investments, and then there is hot sauce. I think you should have both things, but you need to be careful about loading up too much on either one of those things. I know this is a corny analogy, but I promise it might come full circle in a second. Our entire firm was built on this cheesy triangle that we drew in a Word document that still holds up. This works. It works. Sometimes it's frustrating to me too, because I sit here and I geek out and I listen to all the market pundits, and clients will come in who've got their finger on the pulse of the market, and we'll sit there and we'll go back and forth and we'll talk stock and, talk about the latest, greatest trends and should I overweight this? And, the next visit I'll sit will be with a little old lady who just goes, Adam, I like the fact that you shine a light on your wife's grandma and talk about macaroni and cheese and hot sauce. Way less engaged with their portfolio, not following the market. And it's funny, the little old lady goes, just do what you would do for your mother. I hear that all the time. Do what you would do for your parents, Adam. We go, okay, well, why don't we just put a third of the money in things that are going to be very predictable, very stable, principal protected? Why don't we put a third of the money in things that are going to generate predictable, steady income by way of dividends? And then like a third of the money, put it in growth-oriented stuff. Another way to look at it, if you're getting sick and tired of watching me draw triangles on a whiteboard, what if we took a third of the money and we put it in comfort food? Although I don't consider pizza a comfort food. This is what ChatGPT cranked out for me. We take a third of the money, we put it in stuff that's rock solid, predictable. You're not going to lose a wink of sleep. We take a third of the money and we put it in things that are going to generate predictable, steady, stable, hopefully increasing incomes. And then finally, all this AI, all of this innovation, 5G, autonomous driving cars, Optimus. Do you realize that in 10 years, probably every single one of us will have an Optimus robot in our house? We can't be negligent in not having any of our money invested in those businesses, but that stuff is hot sauce. We watched those names, I think it was 2022 when we had that sell-off, we watched those names drop 40% in 2022. The market, folks, can sometimes have a way of seducing us, especially in bull markets. We go, that's where the growth is. I want to follow that. And what I've come to see is the people who follow the market most fervently sometimes are not living the most abundant retirements. They're not spending their money joyfully. They're glued to the ticker tape. They're watching men on TV wearing makeup scare the death out of them. Whereas the little old lady who just goes, hey, put some of it in safe stuff, put some of it in income-producing stuff, and give me some growth. I want to be exciting. I want to own Bitcoin. I want to own cryptocurrency and blockchain technology. I think you should have a little bit of all of it. So, what does this mean? There's a saying in my industry, especially as it relates to the banks, the insurance companies, and the bond issuers, where they say their belly is full. Their belly is full. The financial institution's belly is full. Now, what does that mean? If you could believe it, financial institutions can actually raise too much money, right? Like if an insurance company raises too much money and they don't have anywhere to deploy the money, they're going, crap, how am I supposed to generate a rate of return for this depositor if I don't have anywhere to deploy the money? I don't have any municipal bonds to buy. I don't have a football stadium I could finance. I don't have anything I could purchase with this money to generate yield to create a financial instrument for the consumer. So the saying in that business is their belly is full. And prototypically, at the beginning of a new year, a lot of these financial institutions' canvas is blank. The slate is clean. And they'll have ambitious 2026 initiatives to raise capital. Now, how does a financial institution raise capital? They raise money by offering attractive rates, what we'll call teaser rates. So I'm going to do a quick video, I think, maybe later on this week, but to give you the spoiler alert, this is what we're going to talk about. These are some of the teaser rates that we're seeing being offered by the insurance companies honestly, those fixed instruments, not that attractive. We've seen higher rates. But if you're seeing what your banks are offering by way of CDs right now, many CDs right now are sub 4%. So if you can lock in for 3 years at 5 or 5 years at 5.25, I don't think you look back and regret that decision. Especially being it though, the Fed is telling us that interest rates are going to drop 1.5% in the next 3 years. So while these rates are not the highest we've seen in the last 18 months, they're still pretty high comparative. Now, another thing about these insurance companies, we've even seen rates as high as 6, but they're being issued by companies that, I personally wouldn't trust putting my own money in, so we're not going to tell clients to utilize it either. Fly-by-night companies, low ratings. If we put money in insurance companies or banks, we want to make sure that they're, as financially solvent as we can get. Here's a 5-year linked account, 10.25% cap. So market goes up 15%, you make 10.25. Market goes down, you stay flat. We're seeing cap locks. No, not the button on your computer screen, but cap locks, where you have a guaranteed annual cap of, last product I saw was 8.25. So your cap will never drop below 8.25. And you can lock that cap in for 7 years. Super duper attractive product relative to what we've been looking at as of late. And then finally, I think we'll see a lot of individuals tap into this. There was a product that was released last year that was cut from a similar cloth. It's almost like a hybrid fixed linked account where they're offering year one, they're offering an 8% fixed rate. So you put your money in this account, you get an 8% fixed rate year one. Again, these are teaser rates that just hit the market literally in the last 2 weeks. I don't think they last long. I think they'll be out for a short period of time because I think these companies are going to get a lot of capital, a lot of volume is going to pour into them, and that'll scratch their itch, and that'll give them enough money to go about their 2026 initiatives. So if any of these things pique your interest, please lean into our office, call our advisor up, and they'll talk you through because there's pros and cons. I'm shining a light on all the good stuff. But with any of these accounts, they're going to slap you on the wrist if you leave early. You got to be conscious of surrender penalties. There's minimum investment requirements. Some of these monies fit different in plans, right? You don't want to put your emergency fund in one of these things. These are longer-term investment chassis. Okay, dividend stocks are back. We run a model in-house. It's called our dividend driver model. The yield on it is about 5.3%. Okay, this would be the so if this is your comfort food, if a high yielding teaser rate fixed instrument or linked instrument is your comfort food, here's your income play. Just about every single one of the large asset managers are overweighting value stocks or dividend stocks. If you can get international dividend exposure, even better. And of course, the beauty of buying dividend stocks is even if we're wrong right now, just like they were in 2007 in that Newsweek article, you can at least get a steady dividend hitting your bank account of 5.3% of your initial investment. So we love dividend stocks. I think they're the lifeblood of a retiree's portfolio, regardless of their performance comparative to the S&P 500. I think sometimes we're like, well, dividends have been lagging the S&P 500, which is 100% true. But it's an imperative allocation to a retiree's portfolio. We shouldn't just turn our backs on dividend stocks because they've lagged the overall S&P 500 the last few years. And like I said, just about every big asset manager is saying dividend stocks are, quote unquote, back in the game and a good place to be deploying capital. Finally, past the hot sauce, okay? You got to own these hyperscalers. You have to. And what we love about a hyperscaler is if you have an underlying business that generates the cash flow for you to scale. Okay? There's a saying in the world, they say, pioneers die with arrows in their back. So when I think of someone like a OpenAI who runs ChatGPT, Grok less so, Gemini less so. But these outfits that are innovating in the AI space, but don't have an underlying business that generates revenue, I would be cautious putting your money in those. Not to mention, you look at the large language models, ChatGPT, Grok, Gemini, and there's a couple others. They have been leapfrogging each other in users. Each and every month, it's a different one at the top. So you look back at like the social media platforms, right? Everyone thought it was MySpace. Why on earth would anyone ever want to leave MySpace? You could play music and it's all the rage. And then Facebook comes along and, captures almost all the market share. And there are example after example and example where the first to the party, the first to innovate, prototypically takes the greatest amount of risk, spends the most amount of capital, and they get their time in the sun, but prototypically that time in the sun is very short. So what I would rather do instead is buy businesses that are in the business of picks and shovels. I know some of this stuff is old-timey and you've heard it all before, but look at NVIDIA, for instance. NVIDIA, it doesn't matter who wins the large language model race. They're going to sell microchips to every single one of them. It doesn't matter who wins the 5G race or the autonomous driving car race or, the Optimus droid race. They're going to sell microchips to every one of them. And I'd say the same thing goes for a company like Amazon. Amazon, they're kind of AI agnostic. They're just looking to use the latest, greatest AI to replace humans who are expensive and they create labor issues and not precise with robots and robotics that work 24/7, don't have health insurance, are hyper precise. So, whether this is a good thing for the American economy and civilization, I can't tell you, but the size and scale of the investment that's getting made in this space is earth-shattering. And these companies prototypically don't spend money to get zero ROI. I don't think that's a good financial play there. So I think you have to own the hyperscalers. You have to own. We have a model that we run in-house. We call it our turbo model. It's probably the most popular model owned by our employees. Now, the reason is because our census age here is like 29. We got a bunch of young people running around. But naturally, they want to invest their money in businesses that are changing the world that we live in. They want to invest their money in blockchain and rare earth metals and all the innovation that I've shined a light on this little webinar. So you can't turn your back on growth-oriented investments. Many of you will be invested or retired for 30, 40 years. You can't just throw it all in comfort food. You can't throw it all in dividend stocks. You got to have some of these growth-oriented names and weight them accordingly, right? You want to weight them based on what we just heard from all the big asset managers. Maybe we're overweight value names. Maybe we're overweight middle of the pyramid income-producing dividends. We're going to overweight. We're naturally already overweighting international stocks in many of our models, which brings me to my next point. So just a quick firm update. We have hired 11 new people in the last 12 months. Kind of like strange to even say that out loud. I'll say that out loud and people are like, what do you mean? Like some of these people who've been here for like 3 months, it's felt like they've been here a year. But we've hired a lot of people. This is a picture from our Christmas party. We had just an absolute glass day. We took the Daniel Island Ferry downtown, had lunch, and then drove it back, which was awesome. Dolphins put on a show for us. We paid extra for that. But 11 new people in the last 12 months. One of my initiatives this year is I could be accused of sometimes being, I think sometimes people are like, oh, you're the loudmouth on the radio, carnival barker. It's like, yeah, I am that guy. but we also know a lot about investing, and we're doing some pretty shrewd things as it pertains to rebalancing your accounts and your portfolio. So I'm going to make an initiative to do more of that. So quarterly calls where we, you know, turn the carnival barking off and put like kind of the market maven stock picker hat on and talk about some of the adjustments. Maybe I'll do those with our trading department too. David might join me on those calls periodically where we'll, just unpack what's been going on with our models and how we're changing them. I'm of the thought good investing is like watching ice melt. So, we're never going to be day traders. But certainly, if the market is as volatile as all these people anticipate it to be, you'll probably see more adjustments to your portfolio as volatility increases. One of my big initiatives this year is I did a podcast with Lewis Tyson, who runs the tax team. We have doubled the size of their team. They're still small but mighty, but they were 2 people strong. Now they're 4 people strong. He poached 2 of our most productive employees. So that team's gotten bigger. And I want to see a higher level of connectivity with them. I think the first tax filing year is in our rearview mirror. It was wildly successful. I think most people who plugged into that, found Lewis to be very competent, capable, fairly priced, and they were able to see the synergy between his office and our office. When a form was needed, we were able to relay that to them. I want that trend to continue. I know Lewis is excited to be getting together with all of our clients midway through the year this year. This way, not only will your financial advisor be implementing tax strategy, you'll have a tax team implementing tax strategy. It's almost like another set of eyes implementing tax strategy with you before the end of the calendar year, where a lot of tax strategies can't be implemented, after December 31st rolls around. So we're going to strive to have a higher level of connectivity between our tax team. I am actively looking for an estate planning attorney to hire in-house, no different than what we did with Lewis. Now, we continue to work with wealth.com, and that's a great, valuable resource. I can tell you, Claire and I personally, our trust is designed by wealth.com, right? So I know the work that it's spitting out is of high quality. However, I'd like that experience to be handled with velvet gloves a little bit more. I'd like a human. Call me crazy. I know all these hyperscalers are trying to hire robots. Dumb Adam is trying to hire Americans. But I'm trying to find someone who could, our office can lean into as it pertains to technical estate planning questions. And then our clients can visit with a living, breathing human. I know our client base. Like, you don't want to deal with an Indian call center. You don't want to talk to an AI chatbot. You want to deal with a human being, even with all their flaws. And ideally, you want to deal with a human being who's excellent at what they do. So we're in the market for that. If you know anyone who, we're looking for an actual attorney, or someone they could be a paralegal who spent a lot of time in a estate planning office, please send them our way. Because I just keep kicking tires. I'm talking to all these people, and, I've got this great elevator pitch too. I go, how would you like to make more money, work less, and do better, higher quality work? And that was the pitch I gave to Lewis. And, everyone's like, it seems fishy, Adam. I don't know about this. I like working more, making less, and doing crummier work. Okay. Off you go. Continue being a lawyer. This is one of the problems I have too. Like, lawyers and I are like oil and water. So we're looking for this person. If you know them, please send them our way. It's a really, really, really great gig opportunity. And I know it's going to be of value to our clients as well. We're going to do more events than ever before. Mike is really the guy who does a lot of our dinner presentations. But Ross is going to be out there. Frank's going to be out there. Colin's going to be out there doing these things. So if you're interested in attending one of these, the greatest compliment you could pay us is a referral. If you've got a friend or family member who you're like, hey, I've always wanted them to kind of kick your guys' tires. Well, our office will probably send you our events. Now, they are prospecting in nature. We're capitalist pigs, so we want a carnival bark that what we're doing we think is good and it's a benefit to people. But we're going to be doing lots and lots of events, Myrtle Beach, Bluffton, Charleston. And then finally, my theme this year is just good is not good enough. There's a lot of things that we do internally that I've kind of passed on. I'm like, that's good. That's good. I mean, now with the head count we have, good's not good enough. It's got to be great. It's got to be excellent. And I need your help too. I do not look at your negative emails to me as you complaining. I look at it as an opportunity to improve our process, improve our firm, improve our people. And by all means, that's not an invitation to just send me a bunch of negative emails because I asked you to. But if there's anything that we're doing that's not living up to the expectations you have for us, please notify us so we can improve and get better. Because good is not good enough. It never will be. And mediocrity is a choice as far as I'm concerned. And that's the culture we have here. The culture is unapologetic in that. And I know that's rare. I think when new people come and work here, it's like, hey, like we're going to get better every day. We're not going to coddle you. The expectation is for you to reach a level of mastery in your performance. And when you're not in this office, you should be reading and inhaling this business. And because the people who put a little faith and trust in us deserve it. They deserve to work with stone cold killers, as I'll call them. So I'll close with this. Here are many offices, our many buildings. Of course, our big, beautiful shrine that we built for ourselves on Daniel Island. We'll be moving into the first floor here in a couple months. We're getting a renovation done. Of course, we renovated the third floor. So we encompass the whole entire building now, without exception of the restaurant. There's our office in the upper right up in Bluffton. We moved. We were in like a little Regis working space, which I cannot stand those things, but it made sense for us for a time. We now have a beautiful office space down in Bluffton. It's a stone's throw away from Old Town Bluffton, which, might be one of the most charming areas in all of South Carolina for my money. So if you're down there in Bluffton, Hilton Head, Savannah, come check us out at our new Bluffton office. We'll probably do some kickoff stuff there. And then, of course, our Myrtle Beach office. My wife and I considered moving to Myrtle Beach a dozen times, but, never quite got there. But Myrtle Beach is humming along. And then down in the bottom right is our Somerville meeting space. That's all it is right now. It is one of those shared workspaces. But it's comfortable. It's convenient, most importantly, for our Somerville clients who want to visit with an advisor up in the Somerville area and not have to trudge through 26 and 526 traffic to get to us on 526. Claire and I are actively looking for a brick and mortar standalone office in Somerville. That will probably come to fruition in the next, 3 to 6 months, I'd imagine. But our goal is to keep it as close to our client base as humanly possible. It might be up the road a little bit, but anyways, more to come on that. But I got to see Dave Ramsey speak last week, and he said something that had an impact on me. He said the building would not exist were it not for the people outside of the building. And of course, Dave Ramsey, his building is a $400 million campus that he paid for in cash. Ours is not quite as robust as Dave Ramsey's, but something that we remind our team of each and every day is y'all have a lot of choices. You have a lot of options, and most of those options, just like some of the names I shined a light on today, have much better brand recognition. They've got bigger reputations. And the fact that you chose to put a little trust and faith in our little firm, this little independent investment management company, My American Dream, means the absolute world to me. And I will never, ever, ever let the people in these buildings forget that the reason that their job exists, the reason that the building exists, is not because of their genius. It's not because of the software. It's not because of AI. It's because of the people who put a little faith and trust in our firm. So thank you. If anything piqued your interest in today's presentation, please reach out to us, reach out to your advisor. If you're not working with our firm, come kick our tires, see if what we're doing here is different, see if we've grown, see if we're doing things different than maybe the first time you circled our wagons. God bless. Thank you so much for tuning in to our little webinar today. Let me look at some chat. Is there any questions that I can answer quickly? Bluffton office, get to hear. Kirby, pass the message along. Okay. How do I these numbers? Okay. Okay. I don't know what's going on. Some of these are like, I'm just gonna hang up. If you left a message, we'll have someone reach out and send you an email. Okay.